Welcome to the Deep Dive. Today, we're really digging into Velan Inc's Q1 Fiscal 2026 results. And this wasn't just a standard beat. It feels like it could be signaling something bigger, maybe a real strategic shift for them.
Yeah, absolutely.
So we'll look at the numbers, sure, but also what's behind the numbers, management's thinking, and what it might mean for how you see this space.
Definitely. And Velan, well, they had a very strong quarter. No doubt about it. Revenue hit $72.2 million.
Right, which was above the street's expectation, wasn't it? Around $70 million.
Exactly. Comfortably beat it. And the GAAP EPS, that's generally accepted accounting principles, earnings per share.
Yeah.
It came in at $0.83.
83 cents. Wow. When consensus was basically looking for break-even.
Pretty much, yeah. So a really clear beat just on the standard accounting numbers alone.
But it's more than just the top line, right? The operations seem tighter. That backlog up 4% to $286 million. And the gross margin getting that 100 basis point lift to 28.6%. What's going on there?
Well, those are strong operational signs for sure.
And then the dividend going from 3 Canadian cents to 10. Well, that's a statement.
It really is. A threefold increase. Management's clearly signaling some serious confidence, in the earnings power and the cash flow going forward.
Even with some of the noise in the numbers, like one-time gains and restructuring costs.
Exactly.
Yeah.
You have to look past that a bit. Yes, headline profit got a boost from some one-time tax things. And yeah, they had restructuring costs. But the underlying performance, it really does point to a fundamental beat.
Okay, so let's unpack that underlying performance. Sales up 18.6% year over year. That's pretty significant growth. What specifically drove that?
Well, a big chunk of it came from increased shipments out of their Italian operations.
Italy, okay.
Yeah, especially feeding into the oil and gas sector and offshore production. But they also saw higher volumes coming out of China, India, and Germany, too.
So quite broad-based then, not just one spot.
Pretty much. North America was actually relatively stable. They had strong MRO activity there, that's maintenance, repair, and overhead, which kind of balanced out lower shipments to the defense sector in that particular quarter.
Okay, that makes sense on the sales side, but the profitability, that gross margin jumped from 27.6% to 28.6%. Was that just because they sold more stuff, or was there more to it?
It was a few things coming together. Higher sales volume definitely helped absorb those fixed production, and overhead costs better. That's pretty standard.
Right.
But importantly, they also pointed to a more favorable product mix, and lower material costs helped too. Plus, they had reduced provisions for old inventory. Suggests better inventory management,
Okay. Costs weren't all down, though. Admin costs went up.
Yeah. Administration costs went up, mostly higher sales commissions, which you'd expect with higher sales, and also professional fees. And then you have those restructuring expenses we mentioned.
Right, the one-offs.
Exactly. $5.4 million in restructuring expenses booked. Now, that included $6.1 million in costs related to a transaction.
The French asset sale.
But that was partly offset by reversing $0.7 million in older asbestos-related costs. So, yeah, bit complex on the cost side this quarter.
Okay, so with all that complexity, restructuring, the tax recovery stuff, what does the real underlying profitability look like if you strip out those one-time things?
Good question. If you pull out the restructuring costs, their adjusted EBITDA was $4 million. And that is up from $2.8 million last year. So it does show real improvement in the core operations.
Okay, $4 million adjusted EBITDA.
But then you look at net income from continuing operations, that was $17.8 million, or 0.83 cents per share.
Which sounds great, but
yeah, that was hugely impacted by a $23 million tax recovery tied to that French asset sale.
Right.
So if you adjust for both the restructuring and that big tax gain, the adjusted net income from continuing operations comes way down to just $0.1 million.
Okay. So positive, but just barely on a normalized basis. Really highlights why the strategic shifts are so important then.
Precisely. It shows the headline numbers need context. Oh, and just for completeness, that French asset sale also had a separate $95.8 million gain booked under discontinued operations, plus a negative currency adjustment of $12.5 million. Accounting stuff, really.
All right. Lots of moving parts on the income statement. But one area that clearly benefited was the balance sheet, wasn't it? That French divestiture must have really boosted their cash.
Oh, absolutely. They ended the quarter with over $59 million in cash.
Yeah.
That's their highest level in 5 years. It's a big deal.
More than just a cushion, then.
Yeah, I think so. It kind of transforms them. They now have this significant war chest. It gives them options, potentially for some bold strategic moves down the line.
Now, I did notice cash flow from operations was actually negative this quarter. used $15.5 million.
Right, and that included $6.1 million in those transaction costs, and it compares unfavorably to generating $12 million a year ago. But you have to dig into the working capital changes. It was mostly timing. They had lower short-term customer deposits coming in this year versus a big inflow from collecting receivables last year. So it wasn't really a sign of core business weakness, more just the ebb and flow of working capital timing.
Got it. Not a structural issue.
Exactly. Plus, they also locked in a new credit facility, $35 million available over 3 years. So between the cash pile and the new credit line, they're in a really strong financial position now, ready to invest, maybe look at acquisitions.
Which probably explains why management raised the full-year sales outlook. They sound pretty confident. What's giving them that confidence?
Well, they're pointing straight at that record backlog. And they specifically mentioned accelerating orders in the nuclear space.
Ah, nuclear. Okay.
Yeah, they expect that strength in nuclear to more than offset any slower bookings they might see in oil and gas.
And the backlog itself is changing. You mentioned something about the delivery timeline.
Right, this is interesting. So 84.4% of the backlog is now expected to be delivered within 12 months. That's actually down from 90.5% a year ago.
Down? Why is that good?
Because it reflects a shift towards more large, long-term contracts, specifically in nuclear and defense, and those contracts tend to have higher margins. So it's a shift in the quality and profile of the backlog, even if the near-term percentage is lower. Total bookings in the quarter were still strong at $78.2 million.
That makes sense. Longer-term, higher-margin deals. So does that mean revenue might be lumpier or maybe just slower to recognize but more profitable when it hits? Where are the bookings strongest right now?
That's a fair point about recognition cycles, especially for nuclear. They are longer. But yeah, the trade-off is stability and better margins. As for current strength, China's been active, particularly for industrial valves linked to traditional power development, which is booming there.
What about tariffs impacting China?
Management seemed pretty relaxed about that. They stressed most of their Chinese production sells domestically in China, so it's not really exposed to U.S. tariffs in a big way.
Okay. Anywhere else showing strength?
The Middle East looks promising. Their joint venture in Saudi Arabia just hit its qualification standards and landed its first significant production order. So that's starting to contribute.
And you mentioned MR earlier, maintenance, repair, and overhead. How significant is that piece?
It's a really consistent growth engine for them. It converts to sales pretty quickly because they have this huge installed base of valves out there from, 75 years in business.
Wow, 75 years.
Yeah. And they have something like a 90% penetration rate in North American oil refiners. That means steady, repeat business. This quarter, the MRO uptick was mostly North America, but they are seeing signs of recovery in Europe and the Middle East too, partly thanks to that Saudi JV getting going.
Yeah.
It's just a really solid, sticky business line.
Okay, let's circle back to nuclear. It sounds like a really central part of their future strategy. How are they playing that?
It definitely seems to be. They're working closely with the key players, supplying valves, often proprietary designs for both the standard large reactors and the newer small modular reactors, the SMRs.
SMRs are getting a lot of buzz.
They are. And while, yes, the revenue cycles are longer for these big nuclear projects, management sounds very bullish. They see nuclear as just essential for global electrification.
Are they tied to one specific technology?
No, and that seems smart. They mentioned being a preferred supplier for GE Hitachi's BWRX-300 SMR design, but they also highlighted long-standing relationships with all the major global nuclear providers. So they're kind of hedging their bets, positioned across the industry. It's a long game.
Makes sense. Now, shifting gears slightly, the macro picture. Tariffs are always a concern. How is Velan navigating that uncertainty?
Well, as we said, the China impact seems minimal because of their domestic focus there, and most of their Canada-U.S. trade falls under the USMCA agreement, which helps.
So largely okay for now.
Largely, yeah. But the situation is always changing, right?
Yeah.
Their advantage is having a pretty flexible global manufacturing and sourcing footprint. They can adapt. They did admit, though, that all the tariff talk is causing some end customers, particularly in North America, to maybe pause or delay projects.
But any upside?
Potentially. They also mentioned seeing some early signs of customers maybe shifting back towards sourcing products from North America, which could obviously benefit Velan down the road.
Interesting. And one last thing on strategy. They mentioned a special committee on the call. What's that about?
Yeah, the special committee. It's made up of independent directors, and it's still active. Their job is basically to keep evaluating strategic options to maximize value for everyone involved, shareholders, stakeholders.
So constantly looking at the big picture, potential deals, the future direction.
Exactly. It reinforces that the company is actively thinking about its strategic path, which is always something investors like to see.
Okay, so pulling it all together, what did this mean for investors? How did the market take this news?
So the market loved it. The stock jumped 4.9% the day after the call. And volume was huge, like 4 times the average.
Wow. What drove that surge? Just the beat.
It seemed primarily driven by dividend investors piling in after that huge dividend hike. But clearly, investors liked the clean revenue beat, they liked the better margins, and they seemed willing to look past the noisy bits like the tax credits and restructuring costs to see the underlying improvement.
And was this just the whole sector lifting, or is it specific to Velan?
That's what's interesting. Peers like Flowserve and Xylem were basically flat that day. So yeah, it strongly suggests the rally was very specific to Velan, driven by their results and outlook, not just a general industry trend. That signals real fundamental support.
And how does this fit into Velan's recent stock performance? Has it been a smooth ride?
Not exactly smooth now. The shares have been pretty volatile, actually, especially since that Flowserve buyout proposal from 2023 fell through.
Right, I remember that.
Yeah, the stock slid down below C$6 late last year, but then it doubled, helped by the proceeds from asset sales and renewed takeover speculation. So this Q1 report, it adds some real fundamental muscle to a stock chart that had already bounced back about 30% in the last 6 months. It helps justify that recovery.
Okay, makes sense. Right, let's move to our This Is Not Financial Advice segment. Time to brainstorm an outrageous but plausible trade idea, hedge fund style. What have you got for Velan?
All right, so you take Velan's balance sheet, flush with cash, remember, highest in 5 years.
Yeah.
You take their explicit statement about considering strategic acquisitions, add in the special committee that's actively reviewing options. What if? What if Velan is gearing up for a really transformative acquisition, especially targeting that high-growth nuclear SMR market where they already have a foothold, right? They're already a preferred supplier for GE Hitachi's design. They have proprietary tech.
So the trade idea.
The outrageous but plausible trade is go long Velan. But maybe, just maybe, pair it with a tactical short position against a more traditional legacy industrial valve company, one that doesn't have much exposure to these critical infrastructure growth areas like advanced nuclear or defense, where Velan is pushing.
A pair trade, betting on divergence.
Exactly. The thesis is Velan uses its cash and new credit line to buy something significant, something that fundamentally changes their business profile towards these higher margin critical sectors. They re-rate higher. Meanwhile, the old school competitor maybe faces headwinds. It's a bet on Velan's strategic pivot really paying off in their equity value.
Interesting angle, a bet on M&A and strategic repositioning. Okay, let's quickly recap the key takeaways from Velan's Q1.
Sure. I mean, fundamentally, it was a solid beat. Top line, bottom line, adjusted for noise, driven by good operational execution in key markets around the world. And of course, that big dividend increase signaling a lot of confidence.
Right. And strategically, they seem very focused on those higher margin, longer term contracts in nuclear and defense, using their strong balance sheet now to potentially accelerate that shift, maybe through M&A.
Yeah, that seems to be the picture. Positioning for growth, even with some broader market uncertainties out there.
Okay. And just a reminder to everyone listening, this discussion is purely for informational purposes. It is definitely not financial advice.
Absolutely. And maybe just a final thought to leave you with. How do you think Velan's aggressive new dividend policy, combined with this clear signal about looking for acquisitions, might change who owns the stock long term? And how might the market value the company as its business mix shifts more towards these critical long cycle infrastructure projects? Something to ponder.
A great question. We hope this deep dive gave you some useful insights into Velan and the dynamics in the industrial valve sector. Thanks for tuning in.